and welcome to the Financial Fox. First of all, happy Easter. And I know that it's not the best situation with this lockdown to enjoy the beautiful sunshine outside, but we can actually do lots of things. And one of the things is definitely taking time to rest, taking time to reset, taking time to learn. And what I've been doing is I've been reading a lot about investment. I have been reading books. I've been following different successful investor. And today I'm going to be talking to Clem Chambers, who is a successful British investor. He's also the CEO of ADVFN. That is a fantastic treasure, let's say, for finding all the information about companies. Clem is also the author of these well-known bestseller books about investment, where he outlined the 101 rules to pick up the right stock. And I've been reading this book over the last couple of days. It was amazing. And even though it was written quite a few years ago, it's so actual because investment and the stock market is cyclical.
Some people, when a book first came out, they said, 101 ways, there aren't that many. Well, there was a few more actually, but I thought I'd write another 50 ways to pick stock market winners. But there's so much wrong with so many companies that you need lots of ways of winkling out value and good companies from bad. I mean, there aren't that many really, really great companies, but there's plenty of not so great companies out there.
Anyway, how are you?
I'm good.
Where
I'm good.
Where are you now?
Oh, I'm in my secret location under my volcano.
It's a pleasure to talk to you, and particularly the fact that you have been, what can I say?
Right is the word you're looking for.
Yeah, exactly. You have been calling. You have been calling the crash. When was the beginning of February?
In fact, I wrote an email to all the co-directors of ADVFN that said this could be the big one. Decide what your strategy is going to be and what your trigger point is for moving to a safe place with the ones that you love, which would have been, for me, that was about 2 weeks before the lockup. In fact, Steffi, I've got to say it, which is why I sent you some half bottles of champagne for your isolation. It was you pinging me about Italy and how it was all going pear-shaped there that triggered me. That was the main trigger for me. I had it all stacked up. But when that started to happen, I was in Monaco, which is where I spent a lot of the year at the time. And I thought, oh, this is all kicking off. And then I thought, right, well, on the Monday, this would have been the 24th. I'm going to sell 25% of my shares. If it gets a little worse, I sell another 25, and then I sell another, and so on and so forth. Because, put it this way, my portfolio took a long time to sell because it was of sufficient size. But when I went to sell, my broker was malfunctioning. The market makers were pulling the quotes. They weren't giving a quote and this was just when it was started. This was before the market was even down 5%. The market was so fragile that a first whiff of trouble and bang, they pulled the switch. Well, I went from wanting to sell 25% to wanting to sell 100%. And that day I sold 100% of all my holdings, apart from a few bits that fell between the cracks. And I spent most of the day doing those trades, and I was having to use all sorts of funny gadgets to get out. I was having to do fill and kill and all that nonsense. But, being around a few times, as soon as the market starts to malfunction, there's a big one coming. So that's the major reason I got out, was because the market was malfunctioning. I knew it was coming. I was going to get out anyway, but that market malfunction was the, as far as I'm concerned, the balloon had gone up and I was getting out. Well, that was only 3 or 4% from the top. So I've missed the whole crash. And the big day of the last final leg, I couldn't resist it. I started to get back in again. Now, one should wait to the last leg of the W.
I think a lot of investors are asking themselves, is this crash finished? Have we reached the bottom? Is the right time to start to come back to the market?
Well, I can't say no because I have. I'm about 50% back in now. I'm very nervous of being back in now. And I've been buying stuff that I just couldn't not buy because it was so wickedly cheap. And again, I've been buying stocks which I couldn't buy. Give me a quote on that. no quote, market is not quoting. So, you know, as soon as I see a stock that's horribly crashed and mashed up in the cogs and you can't buy it, that's a real buy signal for me. So I bought a lot of things which have gone up a lot. You know, things like National Express, I bought at the very bottom. Things like Elementis, which is, it just does chemicals, and it was down, you know, 85% or something ludicrous like that. And you end up going around thinking, "What, am I missing something here? Why is this price like this?" Well, because it's a false seller, and they just destroy the price. Well, the market makers, they don't want any trade. They just pull the plug on that, and until they've got stock to sell, they aren't selling, and they're not really buying either, unless it's a stupid price. So when the market malfunctions like that because of the market makers, that is a very strong buy signal for me. So you wait a few hours, wait for them to get some stock, and then you come back and then you buy. So I've been doing a lot of that. But the real question is this the bottom or halfway? That's all you really got to think about. Is this the bottom or halfway? Well, I'm halfway in, and if it's halfway down, I'll get the other half at the other half bottom, and I'll be in 75% of the way down, and that's not a bad average. That's what I'm telling myself as I keep buying. But the real call is this 2008 or is this 1929? And when I look at the dot-com crash, those crashes were 3-year crashes. And the crash in America that we're seeing now, what's been really quite mild, oh, it doesn't half look like 1929. It doesn't half look like the dot-com crash. It really does. So I'm looking at it going, you know, is this a 1929 scenario where the market will go down 82%?
But what would be the trigger now to send it back down? Because it seems it's recovering. So what I'm looking, what will be the fact, the events, they are just going to crash it back again, 20, 30?
Well, there won't be a recovery. There won't be a recovery. People will not go out and they will not fly on British Airways or Ryanair or EasyJet. They won't go to restaurants. They'll just go, oh, I can go out. I'll go out for a walk. Oh, that's fine. I'm going home now. So effectively, the whole society will go hikimori, as they say in Japan. They'll all be a little bit agoraphobic going forward. It will take a long time to rebuild confidence, to start going out and spend.
But listen, within this situation, I understand your point, but there are still companies such as Google, such as Facebook, such as...
No, you're totally wrong. You're totally wrong. Google relies on advertising, 100% relies on advertising. If its advertisers have gone bust, it's completely screwed, pardon my French. It's, you know, Facebook and Twitter and Google are exactly the sort of company which hasn't fallen anywhere near as enough, because the whole model is based around advertising from small, medium and large advertisers. That advertising could well not come back for 2 years. And then what for them? You know, they will be devastated if that happened. And so there really aren't that many companies that aren't untouched. Now, there's 3 sorts of companies in this world. B2C, they're obviously absolutely mullered, okay? Then there's B2B. Well, if the B2Cs are horribly hit, the B2Bs will be horribly hit. The only companies that wouldn't be horribly hit are B2Gs, you know, like Babcock, that looks after nuclear submarines and stuff for government, and is purely a business to government company. Now, they'll be fine. But if the market doesn't come back, if the economy doesn't recover, if people don't go out and spend, then you could get 2 or 3 years of just downhill slope. And that would be a 1929 scenario. But the governments are pumping in vast amounts of money, the sort of money that it's hard to know how many decimal points there are, you know, how many zeros, trillions. This is a new order of magnitude. So if they pump that money in, there's a good chance that it will resuscitate and we'll get a recovery. And that's what, you know, I'm banking on at this moment. But the moment it rolls over and it looks like, doesn't matter how much money they put in, it still won't rescue the situation. People still won't go out. People still won't go to restaurants. People still won't buy Louis Vuitton bags. Yeah. People still won't go down H&M. People still, et cetera, et cetera, et cetera, et cetera. Then, you know, I think you can feel that the 29 scenario, which is a 3-year bear market, is a possibility and probably a strong one. So that's what I've got to decide. That's what everyone's got to decide is this a W-shaped kind of thing? So it might come back down to where it was at a low. It might hook about where it is now and then go on up.
Well, it will depend everything on how the virus is panning out. If you know, it's going to disappear. If you know, this measure
it can't disappear. It can't disappear. It's coming back in October. The thing is, that's not really the issue. The issue is, when do they unlock the first time round? And it looks like they're going to unlock in the middle of May. And that'll be fine. We'll have a recession and it'll all work out. If it's the end of June, we'll have a depression and we'll head towards that 1929 scenario. If they don't unlock until the end of August or something like that, the economy of the West is finished.
So let's go back to, what investors should do at the moment. One of the things will be to start to look for companies, to start to do their analysis, to start to research. That's a really good time to research. And which are the criteria that you would say to investors, right? Look at those criteria for the one that you haven't read the books.
I think right now, if you have to ask, you shouldn't play. Yeah. Because this is a live fire exercise. This is very dangerous here. And if you don't know, don't ask for advice, because it's just the wrong time. This is not normal time. You've got to be a gunslinger to be mucking about in this sort of environment, which, if anybody should be able to get away with it, it's myself. But even I have my doubts. Yeah. Why not just sit on the money and watch it out? Because if it does go 1929, money will be great. But on the other hand, there's so many variables, right? All this new money coming in, it shouldn't generate inflation because it's filling up a deep hole. But what if it does? A lot of people think it's going to create hyperinflation. A lot of the economists will say, doesn't matter what you do with the money, you can't push a piece of string. You can't make people spend money. Give them all the credit you want, but they won't use it. Yeah, so there's the one group of very bright people say it's going to create, you can't stop a depression. You can't pump money in and sort things out. One thinks it will blow the world up, and we're hoping for it to be in the middle. The variables are very, very, very large. So the average investor has to realize it's an incredibly risky game right now. And if they know what they want to buy and they know why they should buy it and they know what's going to happen in their minds, they're really, really certain, then they should buy it. If they're going, oh, they should stay away. They should absolutely stay away, because, this is a very, very, very risky time. Actually, if you were to be, look at it another way, you don't have to put much money back in the market because it's so risky. The results could be so good that you don't have to put all your money at risk. You should put a small amount, and if it's a good time, you make a good return on it, but the rest of it's safe. Yeah, because it's all about not losing your money, not necessarily about making huge profits. Now, if I said to you, look, I'm a championship tennis player, yeah, and you like a game of tennis. How'd you like to play tennis with me? For money. You go, oh, how much money? Well, £100 a set. Every set I win, you pay me 100. Every time set you win, I'll pay you 100. How about that? You go, no way, you're a professional tennis player. You're going to kill me. And I say, well, chances are, yeah. But people go into the market and they are playing against the Federer of the stock market. They're playing against the professionals, right? And in a sense, in these sort of markets, it's hard for them to win, because they are playing against the best, because the other side of the trade is going to be the professional. So it's very, very, very dangerous. But if you know that share's a good share, if you know you should buy it, well, buy some. If you think you should, don't go near it. Just stay away.
And Clem, I just want you to close up talking a little bit about ADVFN, because there are so many tools there where investors can actually use to skim all the companies and, do better research, actually.
Sure. I mean, I wouldn't have been able to call the market like I called it without ADVFN. I wouldn't make the sort of incredible returns that I make without ADVFN. I built ADVFN to be my tool for making a lot of alpha. And I have over the years made a lot of alpha, a huge amount of alpha. And that is because I have the tools to do so. It's like, yeah, if you play Federer at tennis for £100 a point, and he's got a table tennis bat and you've got a tennis racket, you're probably going to beat him. Yeah. And our tools are as good and better than most professional tools. So yes, ADVFN is a valuable tool for anybody that wants to play the markets seriously, anybody that wants to make money.
I just learned about Filter X yesterday.
Yeah. And you go, oh, give me all the companies between the PE of 7 and 12.
Or the one they are paying dividend, and then you spend, you know, you could spend a life looking all the 2,000 companies that have got dividend, and there you can just find all the list right there.
And has fallen over 50% in the last 90 days, and has got cover over 2, and it's got a X, Y, and Z, and an EPS, and you know, it's 1,000 variables, and you can tune right into them. And yeah, there's a little list. Oh, hello broker, can you buy me these please? Yeah, I do that all day long. In fact, during the crash, that's all I was using, because I just wanted to find companies that had fallen 80% that weren't going to go bust. And you go, no, bust. Ooh, that's not going to go bust. 79% down. I'll buy some of that. What do you mean you can't sell me any? Oh, I have that one. Right. I'll call them back in an hour and get some. Oh, really? Well, I suppose it could, or not that much down. No. Buy some of that. Bang. You know, National Express up 100% the next day. But that's what tools. I mean, you know, unless you're a caveman and you want to knock rocks together, the better the tools you've got, the more chances you are going to win, right? Doesn't take a huge IQ for that. But most people want to gamble. Most people aren't deeply interested in making a profit. They might think they are, they might say they are, but if they really were, they wouldn't do it that way. Yeah, they're gamblers, and gamblers are not interested in winning. They're interested in the experience, the rush, the adrenaline, the endorphins you get from loss, the thrill of it all, etc., etc., etc. Those guys lose money, and that's quite a lot of people out there. But if you want to make money, you need tools. It's that simple. You need to, you know, it's a game, and you need the best rackets, you need the best equipment, you need a little bit of coaching, get that from books, and you're in great shape.
I quite like the quote that you said, that if you treat the stock market like a farm, you're gonna get a crop. If you treat it like a casino, it's just gonna treat you as a gamble. And that is really illuminating, I think, for a lot of people. Anyway, Clem, thank you so much. Finger crossed, and let's hope to be already on the fourth leg for the W.
Yeah.
Okay. Thank you, Clem. Bye.
Bye.
This is everything from the Financial Fox. I will see you next time.